You have such a radical change right now in terms of the narrative, in terms of trade, the economy, finance. All of these things are kind of up in the air at the moment. You have caused a great deal of disruption in markets like gold, where, 5 years ago, people speculated on price in gold. Now they're taking delivery. The amount of gold that's actually being delivered in the U.S. is causing a vast amount of movement around the world. And of course, I did an interview with a very interesting guy earlier this week on the blog when we were talking about the fact that the Shanghai Gold Exchange is now the price leader in the world. So I think that, Americans have suddenly been reminded of gold after almost a century, really, since Franklin Roosevelt tried to kill it as money. And I think it's coming full circle. I really do.
Welcome to Discourse with Christian. I'm your host, Christian White. And today's guest is Chris Whalen. Chris is the chairman of Whalen Global Advisors and a leading voice in banking, mortgage finance, and fintech. He's the author of Inflated, Money, Debt, and the American Dream, which has just been released in a newly updated second edition. Chris, thanks so much for being on the show today.
Hey, my pleasure, Christian.
We'd love to start off asking you, what's your current take on the global economy and financial markets?
Well, the U.S. economy is not doing so bad. Everybody keeps looking for a recession. I've been looking for one for over a year. I cover the top banks. We publish an index on them, in fact. And, the consumer is still relatively quiet. If you look at low-income households, they are getting beaten up pretty badly, both in the mortgage market and things like autos and credit cards. But the rest of the credit stack, and I mean 2/3 of it, is pretty quiet. In fact, many banks have been releasing reserves. So instead of building reserves for a problem, you know what I mean? They're actually giving that money back to shareholders. So it's a funny time. On the commercial side, multifamily real estate is a disaster, by the way. But the residential mortgage market's quiet. Very low default rates relatively. In fact, if you look at bank paper, the best loans out there, you can't even lose money because home prices are so strong. If there is a problem, they usually sell the house and give the obligor the net amount once they pay off the mortgage. So, that's why default rates are so low. Home prices have gone up double digits for a year since COVID, remember? And so here we are today, and you don't have a lot of new construction in many markets, especially in the blue states. So markets are tight, particularly that bottom half. If you think about 400,000 is about the average mortgage in the U.S., the bottom half of households are having a hard time finding a home because there's just not much out there.
Well, I'm out here in California, and of course, we're known for our expensive homes out here. And
well, yes, but your market works. In California, if you have to do a foreclosure, you can actually do it in less than a year. In New York, it's over 3 years because of rent control policies. So that discourages building and it discourages lending as well. But, the global economy, everybody keeps fussing about tariffs. But I honestly think that Donald Trump has a very specific agenda. He wants to get countries to come to the table and change their policies. And if we'd asked nicely, nothing would happen, right? So that's really what's going on. Energy prices, many commodity prices are falling. Gold's going up. I'm long gold. But, kind of cautious about stocks at the moment. I bought a little American Express the other day when it got very cheap. But I think they may get cheaper before they go up again.
And as far as Trump's administration and stuff and tariffs and DOGE and things of that nature, could you share perhaps your latest thoughts, things of that nature?
I think the way I look at what Donald Trump is trying to do, he's trying to figure out a way to reduce the budget deficit both in a short-term and a long-term sense. They do want to try and get some kind of tax legislation through Congress, but that assumes that they're going to go out and raise some money or cut expenses. You're talking about a couple $1 trillion. So far, they don't seem to be able to get the House Republicans on board in terms of the cuts that their resolution requires. So I think that, it's still a good ways away. If President Trump gets the House and the Senate to agree before Labor Day, I would be surprised. It's just the nature of things. They're talking about raising the upper rate of people who earn more than $1.5 million a year. I don't think that's going to happen. I don't even think they can take away the carried interest concession from the private equity guys. So, stay tuned.
And then as it relates to just kind of macro big picture, are there any potential events or things around the world that you're kind of keeping tabs on, or perhaps something lesser known that folks should be given some visibility to?
I think, really, if you go back to some of the stuff we talk about in the book, you have such a radical change right now in terms of the narrative, in terms of trade, the economy, finance. All of these things are kind of up in the air at the moment. You have caused a great deal of disruption in markets like gold, where, 5 years ago people speculated on price in gold. Now they're taking delivery. The amount of gold that's actually being delivered in the US is causing a vast amount of movement around the world. And of course, I did an interview with a very interesting guy earlier this week on the blog when we were talking about the fact that the Shanghai Gold Exchange is now the price leader in the world. So I think that, Americans have suddenly been reminded of gold after, well, almost a century, really, since Franklin Roosevelt tried to kill it as money. And I think it's coming full circle. I really do. In July of this year, the Basel Committee that does bank supervision with the industrial countries is going to allow gold as a high quality liquid asset for banks as long as the gold is in the vault. So, one of the things I've learned over the last couple of years talking to people in that market is that if the gold's in the vault, you can borrow against it. It's not true that gold has no carry. It just has to be secure. And that's people are looking for places to store gold in ways that they haven't in many, many years, decades, really.
Yeah, I remember you mentioning in a previous appearance about how even if there was a small exodus from U.S. dollar-based assets, that there's still not enough gold, et cetera, to meet that demand, et cetera, or that void.
No, it's remarkable. The amount of gold above ground that's deliverable is limited. And many global central banks, including most of the European central banks, are now buying gold as a reserve asset. They are largely indifferent to price. They are buying volume. So when you see that, and when you see the natural demand in Asia for smaller bars, the 1 kilo bars are very popular in Asia. And, one of the things I talked about with this friend of mine earlier was the fact that the Chinese Communist Party actually encourages their citizens to hold gold. You can open a bank account in China for as little as a gram of gold. Think about that.
And then as it relates to just kind of the global economy and such, you've mentioned about how the U.S. economy is based on the dollar, of course, and that the global economy
Hmm.
largely as well. Could you share some of your thoughts and unpack that to the audience?
I think that role of the dollar is slowly changing. It was the result of war. We talk about this in the new book. Where do you go over time, right? The global reserve currency, if you go back through history, is something that was usually acquired as a result of war. So Great Britain was the dominant currency in the world for centuries during their colonial period. And then in between World War One, World War Two, the European countries were mostly broke. The U.S. picked up the ball, and that was that. By the end of World War II, the U.S. was the dominant player in the world, and the rest of the world had been destroyed. My wife's family comes from Holland. They all had to leave in 1945. There was no economy, there was no food, no work. So, the global economy's had a great run since the end of that conflict, 75 plus years. But now you're seeing change. And I think that change means we go to a more multilateral world where central banks are going to hold gold, they're going to hold currencies of their trading partners that make sense, and then they'll hold dollars as well. But I think it's a healthy thing, to be honest with you. The U.S. has had to spend a lot in terms of internal inflation and deficits to maintain this facility called the dollar. And everybody's happy to use it. Even if it's just as a means of exchange, they may not use it as a store of value long term. They may want to invest in other assets. But as long as the dollar's there, it's big. You can do big trades like oil and commodities, and it accommodates finance as well. So people are happy to use it for nothing. And I think Donald Trump is basically saying, come and pay for some of this, guys. So it was inevitable. If it wasn't Trump, it would be somebody else, Christian.
And any comments as it relates to BRICS and things of that nature?
Well, the BRICS obviously have chafed under the sanctions regime that the U.S. has put in place, the weaponization of the dollar. So they all want to create a system that is outside the dollar. The trouble is that that's not an easy thing to do. The system that was set up with Russia and China and some of the other BRIC countries are essentially a form of barter. Nobody is willing to take the role that the dollar has of providing liquidity to such a huge degree that we can basically accommodate anything in dollars. There's nothing that goes on in the world economy and trade, finance, that dollars can't accommodate. And then you have the fact that the Treasury issues all this debt. That debt is collateral for transactions. So people can finance in dollars very easily. To recreate that as an alternative to the dollar system is not easy. It really isn't. And the Chinese, the Europeans, the Japanese, those are the three that might consider creating an alternative, but it's expensive. And it means you have to import a lot of inflation because you have to let your currency get big. That's the only way it works. So I think for now, the dollar is still secure, but people look at the fiscal behavior of our Congress and just general misgovernance in the United States, and I think they worry. It's a long-term problem, but it's going to change. Let's put it that way. I think 50 years from now, the dollar could be a third of, or maybe 40% of global trade instead of 80% today. More than 80% of all foreign exchange transactions have the dollar on one side. That's a remarkable statistic.
And as it relates to the global economy and things of that nature, you mentioned previously that it's kind of muddling along and that the U.S. is still doing relatively well.
Yeah.
Does that still stand, or has anything changed in
Well,
your
I
thinking?
would say relatively well. If you look at the stock market, you'd say, yeah, great. My banks were galloping along at 50% annual rates of return last year, but we've given all of that back. The volatility in the market since President Trump took office. Overall, though, I think you have to be worried about consumers because they're not keeping up with inflation. The consumers who can't afford to be invested in stocks or real estate have no way to protect themselves from inflation. So they've been losing ground. The progressive answer was to do things like rent control, which is a disaster, because people are hurting. They're complaining. And yet, I think getting inflation under control in the U.S. is going to be very tough because nobody wants to raise taxes. We don't like paying for things. I talk about this in the book. This is an endemic problem that goes back to the inception of the Republic hundreds of years ago. Even during the Revolution, they couldn't raise taxes to pay for the fight against the British. They wouldn't have accepted it. So, it's always been part of the problem. And since the U.S. thought they could just live on debt for the last 50 years, the fact that now we're starting to see that questioned, and you're starting to see people talking about gold again as a reserve asset, means that the dollar is under threat.
Yeah, I find it fascinating. You mentioned about colonial America, the Civil War, things of that nature. And one of the
Sure.
things I encountered recently, I remember reading something about Franklin postulated that one of the main reasons, I guess, for the break from England was the whole Bank of England and the colonial script, and each colony having their own, and it being not debt based, and some doing better at running their, I guess, fiat based currency than other colonies. I find it pretty fascinating. And then I wanted to ask you, as it relates to, you mentioned about housing. Housing remains strong due to Fed induced pricing and such. Could you share perhaps any latest observations that you have?
Well, we're approaching a reset in single family homes. After COVID, the situation with multifamily apartment buildings and commercial real estate immediately normalized. And investors have been taking some big losses there. I'll give you an example. The market for bank-owned multifamily real estate loans is about $640 billion. These are the best. The rest of it usually gets sold to investors or in the bond market. And they're losing, on average, 100% of the loan amount. That's striking. We haven't seen that kind of loss rate since 2008 in the great financial crisis. So what's going on? Well, consumers can't keep up with rent costs, and they certainly can't keep up with the cost increases for running a building, for example, in New York City. One of the things I always ask my friends is, how big do you think a building has to be in Midtown Manhattan in terms of square footage to make money? We have a lot of little buildings in this city that are not large enough to generate the income they need to be viable economically. So the politicians have responded with rent control and other progressive, short-term fixes, but it doesn't fix anything. And so what you see is a lot of buildings that were financed during COVID in 2021 when rates were really low and the assumptions on payback were extremely aggressive. And now today, the cost of refinancing that building could be 2 or 3 times what it was in 2021. And the numbers don't work. So you literally have relatively new buildings in New York that are fully let. They're full. Tenants are in there, right? But they don't make enough money to pay their debt. The building's upside down. This is what we call negative leverage in real estate. So it's going to be a problem. They are getting ready to bail out some of this market in Washington. They're going to increase the loan amount for FHA and HUD, but that's not really an answer. We need to get people's income up at the end of the day. That's what's lagging.
You mentioned about obviously policymakers, especially over in New York and even out here in California. We are mired in the California affairs, if you will. Obviously, they're influenced by economists and such. You've mentioned, previously about a lot of these economists and such, are politically biased and things of that nature. And I guess it's more of a comment or a question if you care to add to that, how a lot of them have a certain, leaning as it relates to how they see, monetary policies. I don't know if you care to unpack that or share that.
Well, I think California is an example of what we've been living through in this country going back to the Second World War and the Cold War, which is the U.S. was the winner. We seemed to be able to do anything we wanted. And so we developed this progressive narrative on the left that continues to promise people whatever, funded with debt. We use lower and lower interest rates until we couldn't go any lower anymore. So now, since COVID, we've kind of normalized, a 6 or a 7% mortgage is in historical terms not excessive, but the change from zero in 2020-21 to today has been quite a shock. The thing I would point out in California, I've spent a lot of time in California and I love the state, but look at the way the mortgage industry has had to migrate all of their operations out of California and go to places like Texas and Florida and Indiana. Why? Because it's cheaper for their people to live. If you're servicing a distressed mortgage in Southern California, there's some great companies and great people there. They can take care of it. They make enough money to do that. But if you're just doing your typical performing mortgage, sending people something in the mail once a month, that kind of thing, you can't afford to have that business in California. It's too expensive. The per seat price of the people is excessive, and they can't find any place to live. You've seen the reports up in Seattle with Amazon, people living in their cars because housing is so expensive in that market. And again, that's a progressive blue state. They have all sorts of rent legislation. So if I'm a builder, do I want to build there or down in Texas? It's a pretty easy choice. Most of the big builders in New York have migrated down to the Carolinas, Texas, Florida. And that's why you see the overbuilding that you do. So, it's interesting. I think California at some point is going to have to recognize that they need to be competitive. But, New York has the same problem. Illinois has the same problem. Eventually, the politics will force change. I had to actually join the New York mortgage bankers recently just so I can get more involved and talk to some of these people about what they're doing. Because, the 2019 rent legislation in New York rendered a lot of multifamily assets unfinanceable. People live in these buildings, and to have them in such dire straits financially is not good. It's going to be a political problem. You're going to hear more about this in Washington, by the way, very definitely. And Los Angeles is in this same boat. San Francisco is in this same boat.
You mentioned about obviously housing and builders, and you mentioned how a lot of like spec builders are having to rent out kind of a rent to own.
Fascinating. And these are above average priced multifamily and single family homes that we're seeing starting to flip to rentals. That usually means we're getting to the end of the cycle. I learned that in Washington. Washington used to be a go-go market, especially when governments changed. And, when the economy slowed down, all of a sudden everything was for rent. It was for sale yesterday, now it's for rent. So.
And I know you mentioned how the Fed missed an opportunity to cut rates last year, which would have helped real estate and lenders. So
a little bit. I'm not sure the long-term rates would have come down, But if you're, in the market for packaging commercial loans and selling them to investors, having lower short-term rates helps your cost as you assemble the assets, right? It doesn't help you with the pricing though, because everybody prices off the 7 to 10 year treasury. And that's been a little bit more sticky. But here we are this morning. Tens are actually tightening up again. So there you are, 435. The rates keep wanting to go down. That's the fascinating thing with all of the kerfluffle about tariffs and Donald Trump and everything else. The market keeps tightening. In fact, in the first quarter of this year, the middle of the treasury market tightened almost 30 basis points. And if you were reading the headlines, you would think, what's going on here? It's totally against the narrative.
Speaking of that and such, I know there have been parallels drawn between Powell and this. There was a Fed. I'm blanking on the name of the building. Is it Eccles or the Eccles Building? I might be
Eccles.
botching it.
Yeah,
Yeah, Eccles.
Mariner
Excuse me.
Eccles.
And I thought it was interesting how you made kind of the comparison how Trump and Powell have kind of been at
Yes.
it, and even if he were to leave, he can still be in the foray, if you will.
Yes. Well, here's the thing. When people walk in the door at the Fed, I don't care who appoints them, they suddenly go through a transformation and they defend the institution. When you get confirmed by the Senate as a Fed governor, I think things change. And you saw this with the thing you were just talking about. After World War II, Harry Truman basically wanted the Fed to keep rates low, much like Donald Trump. And he went through this whole thing, big confrontation, and finally decided not to reappoint Mariner Eccles. He appointed an existing governor, Tom McCabe, who was one of the most courageous Fed chairman ever. And so Eccles, to support McCabe, didn't leave the board. Even though he had not been renominated as chairman, he was still a governor because the terms don't run consecutively. And so he stayed to support Chairman McCabe until his term as governor was over. Same thing could happen here. You have the board, you have both Trump and Biden appointees. Powell can stay there until 2008. So that would mean there wouldn't be an open slot for Trump. He'd have to wait till another governor's term expires. I think there's one or two before Powell is done. And so he'd probably have to appoint Mickey Bowman, which is not the worst thing in the world. She's a great governor. But they've just had her appointed as the vice chair for bank supervision, which she's extremely well suited for, by the way. She worked in the industry. And, so it's a pain for the president. And yet, like I say, all Fed governors, I don't care who appointed them, when they get into a political pissing contest with the White House, they dig in their heels. And this is why Powell's not cutting rates. If they didn't have that adversarial relationship, I think Powell probably could have cut rates by now. So there's a lot of personality and politics as well as policy involved here.
Now, I know you were involved for the state of New York and its reserve board capacity. Could you share what that experience was like and perhaps some insights?
Working at the Temple? Well, when I worked at the New York Fed, it was a very different institution than it's become since the great financial crisis. The Fed in the old days, still had a large degree of independence. They mostly conducted bank supervision in the bank. The board really didn't get involved. I worked for Paul Volcker and then Jerry Corrigan. And both of these men had to go out and clean up a lot of messes in the private sector, failing broker-dealers, failing banks, what have you. And they did an extremely good job of it. But I have great memories of working at the Fed. It was all downtown. Just about everybody I worked for, I was in bank supervision first, and then I worked in the foreign exchange department. As my dad would have said, everybody in that department was the son or daughter of a fireman or a policeman, but that was New York. New York was very much still the melting pot. So the children of the firemen ended up working at the Fed, and that was kind of a good job. They were working up the ladder. And it's still an interesting place today, but it's changed a lot. The board has taken over most of the decision-making functions in the Fed system, and I think that's a shame.
And as it relates to the labor market and fiscal policy, you mentioned private sector being dynamic and people are keeping jobs, especially in healthcare, transport, and finance.
Yeah.
Could you unpack that, please?
Americans are resisting the idea that there should be a recession. They are working very hard. They're hanging on the jobs. During COVID, people were prone to give up a job and go look because there was a lot of demand. Businesses were having a really hard time getting good people. Today, it's a little different. I think people are working very hard. They are worried about what's going on in Washington and some of the uncertainty that you read in the media. But I overall think that the unemployment rate is going to remain pretty low simply because the markets are tight. I don't see a catalyst out there that is going to surprise the markets and therefore cause a crisis. That's usually what has to happen. We have to miss something, a company going bust or a bank rolling over. You saw that with Silicon Valley Bank a couple of years ago. That surprised everybody. It shouldn't have. It was right there in the data. But, people don't look at data. They leave that to dim people like me.
And I know you see more of shrinkage going on in the federal government and such, with obviously those jobs continue to decline. Any further comment on that
Yeah, we're
topic?
going to continue to see shrinkage in the public sector, very definitely. Trump and Doge are going to go through the entire government probably several times. I hope they will be careful because not everything they find is what they think it is. You remember early on when Musk said they had found $1.9 billion at HUD that, we didn't need anymore. And I had to write about this in my column for National Mortgage News. I said, no, that's the budget line item for the two standby servicers for Ginnie Mae in case a Ginnie Mae servicer fails. You don't want to not have them there, right? We had a failure in 2022, by the way, a reverse lender, which the U.S. Treasury now owns and has cost the taxpayer billions of dollars since that failure. So it's very important that the government lending market have that backstop. So, the Trump people have to mind their details. But what I would tell you is this. In Trump 1, they cleaned house, but they really weren't ready. They didn't have candidates for many of the positions that they had to fill. This time around, they're very prepared, and they were able to fill all of the seats that didn't require Senate confirmation, and they have obviously a lot of people waiting on the Senate now. But I think this time around, the Trump people are much better prepared, and that's why they're getting so much done, much to the chagrin of the Democrats. But I think overall they are doing the right things, and we'll just have to see if the economy, is going to be worse or better as a result. I think there will be a shock from the tariffs and the sudden drop off in trade flows. There's not a lot of ships heading for Los Angeles right now from Asia, and that's going to be a big change.
Yeah, I know the California governor has spoken of going toe to toe because of the tariffs and the economy here. So
Yeah.
that's
Governors can't really do anything about tariffs. They control certain things at the state level, like real property, many other aspects of day to day operations. But tariffs are a federal matter that are enshrined in the Constitution. So it's going to be really hard, I think, for the states to find standing to actually challenge the president on this, because his authority comes from Congress. And again, the states are not in a good position to challenge something that applies to all states. That's what interstate commerce is all about. So for better or for worse, if the president decides to make trade an issue, he can. But look, he's cut his deal with the Brits, and he's going to cut his deal over the next few months with every country that we don't really have a problem with, if you think of it that way. And the remainder are going to be the Chinese and the Koreans and some others.
now I know you've also mentioned kind of an ideological battle going on between a shrinking private sector versus more of an expansive progressive government. Can you
Yes.
can you dive into that?
Well, the Bush, excuse me, the Trump people would like to get Congress to make a lot of cuts in various programs and kind of permanently roll back some of the overhead costs of government, and they are doing that. The real cuts, though, have to come from things like military spending, Medicaid, Medicare, and that's not going to happen. The politics of that are very difficult. And even if you convince the House Republicans, who tend to be more conservative, to come along, in the Senate, they're not. They're just not going to do it. So Trump still has a bit of a quandary in terms of how much support can he get in the Senate for tax cuts and other things, while at the same time appeasing the more conservative elements in the House.
Gotcha. And then as it relates to markets, valuation, and investment strategy, I have down that you predict tighter markets and more fundamentally driven a trading post Fed eats era.
Yeah, I think what the way I would put it, if I look at financials have been riding on a lot of different waves that came out of the COVID period, the huge amount of liquidity that was out there. When we thought we were going to have Fed rate cuts in the third quarter last year, the markets rallied. You saw a big uptick in lending volumes, rates fell, and the financials took off. Some of them were up 60, 70% last year. In fact, if you look at things like SoFi, for example, the best performing bank in the country, it's a consumer lender, right? On the mortgage side, Fannie Mae, Freddie Mac are the two leading stocks because the hedge funds led by Bill Ackman are talking about them being released from government control. We'll see about that. That's really a function of what Trump wants to do with taxes. If he needs $300-400 billion to fill in a hole in his reconciliation bill, then they may try and release Fannie Mae and Freddie Mac. But I think, overall, we're still kind of waiting to see what happens with Trump. At the end of the day, he may only be able to extend the existing tax cuts, which I think would be a bit of a defeat for him. But, well, we'll see. It's got to get done soon. Congress goes out of town at certain points this summer. And if you don't have this sewn up, by the end of this month, May, then I think they're going to be really behind the eight ball.
Gotcha. And as it relates to obviously what Trump's done and such, and what's gone geopolitically and such, as far as like global investors, I have down highlights that there being a lack of alternatives for global investors exiting U.S. assets. Can you share?
Well, think of it, the dollar is such a big currency. Where are you going to go? Let's say you're the Bank of China and you decide to sell all your treasury bonds, and the Japanese would probably come and buy them, by the way. So you're sitting there in cash. Where do you go? Do you buy commodities? You buy gold? You probably can't buy that much gold because there isn't that much deliverable supply. Another metal that's going to tighten up, by the way, is silver. Silver gets consumed in industry, so the amount of supply above ground is essentially shrinking all the time. And I think that that's going to be an interesting story as well. I'm long gold right now. But I believe, you have to be cognizant of the arbitrage between paper and gold. Paper is basically the dollar and stocks and everything else. You have real estate as well. But I would be cautious about real estate right now because we've had such a run, thanks to the Fed and very low interest rates during COVID, that we're getting ready for a reset in residential real estate. Commercial, same way. You can't even parse what's going on with some of these stories because they're all different. Every building has a story. Every location has a story. So it's a very dangerous thing for retail investors to get too involved in real estate. But I just put out a piece on some of the big lenders like United Wholesale and Guild. They're doing okay. They're making money, but volumes are very low. Volumes of new securitizations of mortgages are very low. And that kind of activity, it doesn't give you great confidence. You'd much rather see the markets a little more busy, but 7% mortgages are not that attractive to consumers. It's a price problem. So that's kind of how I see things. We're not in a recession yet. We may not see that all year. We still may not have a catalyst that says the Fed go cut rates. That's kind of where they are now. Because if you look at the data that they care about, it's all over the place. Depending on which data element you want to focus on, you could come up with a rationale for cuts, or you could come up with a rationale for increasing interest rates. Because remember, the Fed didn't force rates up long enough and high enough to actually get home prices to come down. They were afraid to do that. If we were living with Paul Volcker, we would have had 10, 12% interest rates. But, they can't do that now. They're worried about the treasury market.
As it relates to, interest rates and such, I think of so many people. I provided housing on and off throughout, actually since around 2020. And one of the things that I've shared with other guests is the number of people, I'm in my 30s, but I've had a number of people twice my age reaching out for housing and such. And it's been very alarming, kind of either hearing about their story or just the lack of, the prevalence of requests on various rental sites, et cetera, that I've encountered. So, and yeah, I mean, when you have a 2 3/4 interest rate and now it's at 7%, et cetera, on average. Wanted to mention real quick as it relates to your book, obviously that you just released. I grabbed my copy. If you could kind of share and talk about what the second edition encompasses, some of the changes that you've made, and perhaps some of
Sure.
the etc.
Well, what I did with the book, it had been published 15 years ago, and Wiley was kind enough to allow me to come out with a second edition. So I took about 20,000 words out of the front. I took the stuff about Henry Ford out because I subsequently published a book called Ford Man that goes through his role in the Great Depression. Henry caused the banking crisis in 1933 when FDR took office. When he said, "We have nothing to fear but fear itself," that was because all the banks in the country were closed when he took office in March of 33. So that was why they changed it to January, by the way. There's a constitutional amendment that happened after that. And then what I did with the rest of the book is I added a new chapter that talks about Ben Bernanke, Janet Yellen, and obviously Jerome Powell, how they handled COVID and afterwards, and really kind of paint the picture of where we're heading. I wanted the book, Christian, to be a nice, concise history for people to understand how we got to where we are today from the beginning of the country, how Abraham Lincoln, how Roosevelt played a part in how we know money in this country. And then, we try and paint a picture for what's going to come. But what I can tell you is Americans don't like paying taxes. That's the one constant. And inflation has been a constant too. It's almost impossible for a democracy to have sound money. There's a great Hayek quote in the front of the book that sums that up. And I didn't change it because you know what? It was good the first time, it was good the second time. Hayek was right.
Yeah, I was going to comment and mention. I'm not super intimately familiar with all the nuances to finance, especially historically. But it seems, I mean, obviously, debt has been a component of civilization for millennia. But I
Yeah.
presume that with the 1960s, more or less around their credit cards rolling out, there's just been more of a society predicated on debt than past epochs.
Well, yeah, I mean, think of it this way. In the 20s, you had the great boom. In the 30s, you had the liquidation of basically all private sector debt in the United States. Friedman and Schwartz talk about that in their great history of the U.S. Then after that, it was all government finance coming out of World War II, big banks, big corporations, until you get to the 70s. That's when you started to see non-bank finance come back and you started to see consumer finance. Because before the 70s, if you had gone to a bank and said, "I want to get a mortgage to buy a house," they would have laughed at you. They didn't do that. We had savings and loans, we had loan brokers, and very limited access to credit. So the democratization of credit, Jimmy Grant's great phrase, right, has gone on since then. And we almost don't even worry about people paying back the debt. You saw this during COVID. We had the moratoriums on rent and debt caused huge problems. In fact, the problems being felt today by multifamily apartment properties and that sort of thing go back to COVID. Because politicians were very happy to subsidize consumers, but there was no love for people who own commercial real estate. There's no political constituency for that. So I think, unfortunately, we got through COVID remarkably, and there were both good and bad about the policies that were taken. And I try and frame that in an understandable way in the book.
And as it relates to just kind of the journey, writing the book and such, any other things that you'd like to unpack or share?
Sure. Well, people often say to me, "Gee, Chris, how did you write this book?" And the answer is, for all writers, you have to put your butt in seat and write. And that usually occurs early in the morning. So if you're working on a book project, you want to get up at the crack of dawn and try and get as much done between then and the midday as you can. Because most of us have jobs and have other things that we do. My good friends years ago would have said, "Chris, writing books is great, but don't give up your day job," right? So to me, that's how you get it done. Now, I write newsletters. I write a column for National Mortgage News. So churning out copy is relatively easy for me. And what I did with the book was just sat down and I had to spend about 9 months adding to it. And the folks at Wiley were great. We have new techniques now for doing copy editing as a group. It was fascinating. We had this Adobe file that everybody could see in real time. So we could sit there and ask each other questions and say, "Hey, should we take this out?" So it actually worked pretty well. But, it's a labor of love. I'm glad I'm not working on another book right now. I had just done a biography of Stan Middleman, the founder of Freedom Mortgage, in 2024. So that and this was a fair amount of work.
I know you've mentioned he's one of the sharpest minds that you
Oh
know.
yeah, I love Stan. Stan is a, mom and pop business. It's now become one of the biggest government lenders in the United States, all through hard work. He's still private. He issues debt in the bond market for institutional investors. But he and his family run that business, and they were top two buyer of conventional loans last year. They were chasing Rocket and United Wholesale Mortgage. So it's a very impressive organization. And what I like about Stan is he's very modest. He has simple rules for governing his business because he heard Paul Volcker speak once: employment on the one hand and inflation on the other. If you watch those two guideposts and you're in the business of consumer lending, that's basically what you need to know. But today we have so much volatility going back and forth. It's a real challenge to run a business like that.
Do you care to share or dispense to the audience some of the advice that perhaps he's instilled or imparted that's kind of delineated him from others? Or
Well, the key thing we have been discussing is his prediction of a Max C home price reset in 2028. Stan says in the book, he goes, misery on the eights. In other words, every decade or so, you typically have to have a reset in these markets. The Fed has made that even more essential because affordability is non existent. And I think Stan's going to end up being right because basically his prediction was the Fed will eventually cut rates. So let's assume they cut rates once this year, maybe a couple times next year. You see a little mini boom in lending. You may see home prices go up more, which is crazy, but it may happen. And then after that, you're probably going to see a significant reset. He thinks we go back down to 2021 levels, which means a 20% decline from where we are today. That's not the end of the world, but that is going to be quite a shock. And it's going to put a lot of loans that have been made, say, since 2023, 24, going to be underwater. And those borrowers, the cost of borrowers that get in trouble is suddenly going to be visible again, Christian. Because what you see today in the market is home prices are so high that if a borrower gets in trouble, they just sell the house. You never see a foreclosure. And many consumers, unfortunately, are selling their homes and going to rentals. They're just making a payoff and they're leaving. That indicates that they can't afford to keep the house, which to me is very troublesome. So I think inflation is still a big part of both home prices and the ability of people to stay in a single family home as opposed to going into an apartment.
absolutely. Well, Chris, it's been an honor having you on. How can people learn more about you and get in touch?
Well, I'm Chris Whalen. I'm a banker. I work with a lot of big institutional clients and financial institutions. I publish a blog called The Institutional Risk Analyst. I'm active on X and LinkedIn under RC Whalen. And I write a column for National Mortgage News if you happen to work in the housing industry. I'd like to hear your questions. We take questions on X. We like to put the answers up there so everybody can see them. And I appreciate the people looking at the book and look forward to your comments.
Well, I'm looking forward to reading. I ordered my copy, and I encourage the audience to do so as well.
Thank you, sir. I appreciate your time, Christian. Let's do it again.
Likewise, Chris. Take care.